Welcome to the V2 in the 6 video series of Stan Weinstein's. And in our video 2, today we will be discussing when, what, and how to buy. That is very important because whatever stage analysis, that is whatever framework you learn. If you have these three questions answered in a logical way, then everything else that comes later on, that is refining the buy, selling, shorting indicators, this becomes easier. So today in this video, we'll be going in depth. And if this is the first video, I would advise you to go through the V1. The link is in description. Watch the V1 first, then you can watch V2. So let's begin. And as usual, we will be using this whiteboard to learn, and I'll explain you a great deal of things here. So in this, first we'll see when to buy, investor's way, trader's way. Then we'll move on to the breakout versus pullback debate from the book. Then we will see what exact system did Stan Weinstein was following for scanning the stock and making the decisions. Top-down approach as he has taught. Then we will do sector analysis and what you should know about sectors. And as a bonus in this video, I'll show you one live case study of a stock using the current knowledge that we have. So we are watching the slides and see, the secret here is when we talk about how, when and what, the simple secret is what Stan is trying to tell you is, in other words, you have to time the market. This is a very simple sentence, but you have to go beneath that. That if you buy the pullback, you have to buy exactly where the pullback is ending. If you buy a consolidation, you have to buy where the consolidation is ending. That is the message Stan is trying to get across. And in this video, we'll tackle this question and whatever I've written. And also on your part, you can think about it. See, in the book, he has given two ideal entry points. And he has further divided that into two ways. The first one he calls the investor's way. And the second is what he calls as the trader's way. I have a problem here. And that is this word, investor's way. See, if you see logically, there is no differentiation between a trader and an investor. When you say trader, that doesn't mean he is by default a short term. When you say an investor, by default, that doesn't mean he'll hold for a long period of time. So these two terms, I would say, are simply used to kind of differentiate on the basis of time. If somebody is holding something for a long period of time, then he is classified as an investor. If someone just, gets in and gets out very frequently, then he's termed as trader. What I would say is that there is no trader, there is no investor. Everyone's the same. You have to buy, you have to sell, right? So if you want to use one term for that, the better term, better word is called as trader. Investors choose to hold for years, while the traders in conventional sense choose to sell it quickly. But for the sake of this book, I'll be using both the words and I'll present everything how it has been given in the books. But this is another thought on a thing which you should think about and take a little inspiration from. Now let's get all this data on the slide to our whiteboard. So here, the investor's way, what do we have exactly? Let's see. Looks good here, I think. This is visible. And we have some more data. We'll take up another slide for that. And then we can begin. Very important concepts about breakout buying and pullback buying are discussed here. So let's first focus on this. He calls this as, if you see here, the investor's way. Okay. When Stan is using the word investors, he's saying somebody who will keep holding the stock for the entire stage 2. That is what he means by an investor. So get that point very clear. So basically holding for a long period of time. Then he says there are two great times. That means two entries for an investor. That is new buying both around the breakout point. That means the first entry point, as we also discussed briefly in the first video, will be around the breakout point, and the second also will be somewhere around it. So those two are classified. One, the first entry will be called as the breakout entry. The second will be called as a pullback entry. Let's go deep into it. First, we'll cover the breakout here at this point. So here he says that the first buying point is when a stock initially moves out of its stage 1 base and enters stage 2, right? What he's saying is, this is how the stock behaves in your stage 1. Then this happens. So according to him, the red line that I've drawn, kind of a resistance, this is where you take your first entry. The second, and the important word here is this. I would like you to pause the video and think about it. What does he exactly mean by safer time? Why is it called as a safer time when a stock pulls back towards the breakout point after the initial stage 1 buying frenzy burns out? So what happens is a stage will come where the stock will come here and then take off from here. So the first entry point was also here. The second was also here. My question to you is, if you go onto a chart, or I'll show you with a drawing more clearly, you will see that both the buying points, as he said, are around the breakout point. But why the first one is not called a safer option and why the second is called? That is the important question that you need to think about. So I'll put up a diagram here and show you what he's trying to ask. So this is what is happening in your stage 1. Then a move comes and then the stock pulls back and gives you a move, and then you have a stage 2. What he's saying to you is this. You draw this resistance here. When the stock is breaking out, out of stage 1 and going into stage 2, this is where you buy, the first point. The second point to buy here is this. He calls this as a safer option. The question is, why this is a safer option and this is not? You should think about it. I'll explain. See, when you're buying here, what all possible scenarios can happen? I'll tell you. In this case, this is the ideal scenario that happens. If this happens, well and good. What can also happen here is the stock breaks out, but then it comes back in the range and does this. And it again goes into what? Stage 1. And stage 1, what does he say about it? That can take a very long time to move the stock from stage 1 to stage 2. This is something that can happen. Once the stock has successfully broken out, in the case of the black line, and it is pulling back to the breakout level, and that is where you see the demand, that means the breakout was actually successful and the probabilities of a move continuing, the stock continuing into the stage 2 is much higher. And that is why this is called as the safer option. That is point number 1. The second point is, this is the point where the resistance was. And if you know about support and resistances, they're kind of interchangeable. Something which was a resistance generally turns into a support and vice versa. So if there was a resistance and price is now coming close to the previous resistance, then it should act as a support. So what happens is when you buy here at this given point, and if the stock from here hits your stop loss and goes below this level, then you can be rest assured that now the stage 2, the probable stage 2 is over. You are again back into the stage 1. But if you buy anywhere above this level, and your stop loss is hit, let's say you buy here, but your stop loss is hit, still the stock can pull back till the breakout level and that is safe, no problems. But if you are buying near the support and the stock goes below the support, stays there, then the stock is done. There is no stage 2. So you don't have to worry about that. That is what Stan meant when he was talking about safer option. I hope you understood this point. This is very important. Then he talks about buying the pullback here. Let's make it a little prettier. And now let's understand. See what he's saying here. When talking about the pullback, which is the safer option. Why is it? I've already explained to you, but let's see what Stan has to say. The advantage of purchasing on a pullback is that you can play a movie critic, and judge what you have seen. Exactly what he's saying. Because when you buy here, you know the breakout, how was the breakout, right? If you just buy here and let's say it comes back down, you never got the chance to judge here, right? You cannot judge here how the breakout is going to turn up. But at this point, sitting here, you can see how the breakout was and how the pullback is happening. The reason he gives is about the volumes. But there is something that I'll teach you in separate in the video 6 about the volumes, which is not mentioned in the book. Then see, did the stock move far above the breakout point? As we talked about it. See, the stock could have done just a small poke out above the resistance level and again come back. That is not what you want to see. You want to see a substantial move, is what he's trying to say here, the percent move. Did volume then contract on the pullback? This is again something which he himself contradicts as he goes forward in the book, and I'll highlight that when we talk about the volume part. So again, this is a point which you can ignore as of now. I'll go in deep into that. So whatever doubts you have, just keep it in your mind. Or is it just a nudge, above the critical resistance level and then fall back below it? We talked exactly about it, which always signals a red flag warning. Now here is one thing. He says once you have watched the action, that is the breakout, you know whether you are dealing with a potential A plus or C minus. Here, he basically is giving you an idea to build a priority list, that make a list wherein you shortlist stocks, all the stocks, and then among those stocks, you have to select the stock which are excellent, stocks which are good, and stocks which are bad. That is what he means by A plus and C minus. So this is the idea you need to take away, that always have list sorted accordingly. Good stocks, excellent stocks, bad stocks. Bad stocks, you can just clean the watch list, and you have to be very focused about the excellent setups. That is what he's trying to say. Then he talks about, should you wait and only buy on a pullback? If he says that pullback is the safer option, then you would ask him that then why am even buying the breakout? Why to even buy the first time here? Why not enter everything at once here? Then he says that if you wait to do only such low risk buying, you are going to miss out on some of the greatest winners. I'll explain through chart what he's trying to say. What he's saying is, what can happen is, your stock, let's say this is the resistance line, your stock breaks out like this, consolidates like this, and boom, it never looks back. It never gave you a proper pullback, is what he's trying to say. For this also, I'll give you another reason for that. But here the concept, the secret I gave you in the video 1, called as it is a relative concept, will help you to think forward, right? So he's saying if you only wait that, okay, the price has to come here, then only I'll buy, then definitely this is the stock that you will miss. So what he says is you buy some here and then you buy some at the pullback, so that even if it doesn't pull back, you still have some quantity in the stock. That is what he is trying to get the idea across. Now let's move on and let's see what he's talking about for investors in some more detail. So let's get this data onto the slides and study more. Now see, there is a diagram that he is using, but let's first read this and then we'll go on to the diagram. What he's saying is, see what he's saying. The word he's using is a long-term investor, right? So he could have said a long-term trader, but now we know that investor and trader is nothing. Everyone is a trader. Compromise and buy half of your intended position on the initial breakout. He's saying you that जब breakout होता है, just buy half, and the rest is other half, if the stock pulls back close to the breakout price and you like the post breakout action. This is a very important point. Post breakout action is very important. There are a lot of things we'll discover about this, but just keep this point in mind. Whatever kind of trading you do, that always happens around an event. There is an event that you classify where you are interested in the stock, and the action that happens after that is where you should focus upon. In this case, the event is what? A breakout. And post breakout action is what we are interested in. So this is the concept he's trying to get across. Then he moves on to say that it's an especially good point for investors. Again, for a long-term trader. At this juncture, the risk is extremely low. Let's hear what he's saying. Since the base of support is just underneath your purchase price, right? But my question to you is, what does exactly this mean? Risk is extremely low. Is he talking about monetary risk, which is not dependent on the market, depends on you how much money you want to risk? So definitely it could not be about that. Because there will be someone who will be risking 1 lakh rupees. There will be someone who will be risking 500 rupees. Somebody will risk 10,000. So that is something that varies on to individuals. What he's trying to say is that the risk of your assigned stop loss getting hit is very low. That is what he's saying. And why is that? Because the base of support is just underneath your purchase price. As I said, अगर उस support के नीचे, if the price dips below that support and stays there, then you know your support has failed and the stock has eventually gone again into a stage 1 area and your stock is done. So you don't need to worry about. See, what I'm trying to say here is this. I'll give you scenarios, 2 scenarios. This is your range 1. You break out, then you consolidate here, right? Let's draw the resistance line here. Now let's see what can happen. Let's say somebody decides to buy yahan pe, thinking that we will go up from here on. But what actually happens is this. Now tell me, are you back in stage 1 again or this is normal pullback? This is normal pullback. So यहाँ पे अगर आपने stop loss दिया है तो वो गलती आपकी है, not of the stock. From here on, if the stock does this, very good. This is what we are looking for. So see, getting stopped out here meant nothing. You were still in stage 2. But let's say at this point, stock does this. अब आपका यहाँ पे stop loss hit हुआ. But along with your stop loss hit, your stock also went from potential stage 2 to what? Again stage 1. Right? So when you are going wrong, that is your stop loss is getting hit, your stock is also going wrong, which was not the case in the first instance, but was the case in the second instance. And that is what is important here. That is what he means by this. Then he talks about it that equally important is the upside potential is tremendous because you are exactly buying here right at the onset of stage 2. Then he says the only drawback is that it can take time for solid stage 2 momentum to build. If you see here, the stock was going slow, then consolidated at this level, and then gave you the move. So what he's saying is it could take a few months because he's talking about weekly time frame setup. That means अगर 10-12 हफ्ते उसने निकाल दिए consolidation में, you have to be fine with it. And 10-12 weeks is what? Nothing but 3 months. That is the amount of patience he's talking about. But again, for that patience, you definitely are getting a very good risk-reward ratio. This is what he means by this. And see here, if you see the drawing now, this is exactly what he's trying to say, right? Forget about the moving average. I'll talk about it later on. But see, A point is the breakout. That is where he's asking you to buy. And when the stock is pulling back here, this is again where you buy, which is the low risk entry. Then he goes on to take about the trader's way, and this is important. So let's get the data from here onto our slides and see what he's trying to say. But again, we know that trader and investor are essentially the same thing. It's just that the traders usually get in and out quickly, while that's not the same case with someone who you would call as an investor. Now see, traders way. What he's saying is when the stock drops back close to its moving average and consolidates, it then breaks out above the top of its resistance zone. This is called as a continuation buy. Okay. Forget about the moving average, as I'll explain you in deep about the moving average. What he's saying is that the risk factor here is a little greater, and I'll explain what he exactly means by that. Then what he says is a rule of thumb. He gives you a rule to the investors, basically someone who intends to hold for entire stage 2, that they should do about 75 to 80% early stage 2 buying, remainder coming from the continuation moves. Traders, then he says, on the other hand, should reverse the figures and do 80% of their buying on the breakouts that are already in stage 2. This entire paragraph gives you a great setup to trade. How is that? I'll draw a very elaborate diagram to explain that. So what is happening is there is a stock which is in your stage 1. Then what happens? You break out, then you pull back, let's say, then you slowly starts to go up. Then this happens. Then again a move comes. And this is how your stock basically moves in your stage 2, right? So what I would ask you to do is wear the hat of an investor according to it. Where will you buy the first time as an investor? What he says, as an investor, 80% early buying, stage 2. Basically, 1 at the breakout, 2nd at the pullback. So first entry for the investor, second entry for the investor, and 1 plus 2 has to account for what? Almost somewhere around 80% of your intended position. If you want to buy 10 lakh rupees worth, you enter with 8 lakhs rupees combined in 1 and 2. Then he says that the remainder coming from continuation. So let's first understand what is a continuation move here. When you buy here 1 and 2, that is not continuation buys, because here the stage 2 is just starting out, right? It could come back in. So you don't know whether the stage 2 has completely started or not. But when you buy somewhere here, when this breaks out, you know that you are in a stage 2 now. This breakout buying here is called as a continuation buy. Then again, there is another area. These areas to buy are basically what? Continuation areas to buy. So this is what he's saying. So rest of the 20%, you can say I buy 5% position more here, 5% more here, 5% more here, and so on and so forth. You can keep on buying and adding into your positions that were added here. Let's say what he's trying to talk about to the traders. Traders, on the other hand, should reverse the figures and do about 80% of their buying on breakouts that are already in stage 2. So for traders, I'll use a green ink. What he's saying is, the one that you see here of the investor and 2, this is not where you buy your 80%. Let's say you want to build positions of 10 lakh rupees. Combining 1 and 2, you will buy what? Somewhere around 20% of the intended amount. If you want to buy 10 lakh rupees, you simply buy worth of 2 lakh rupees here. That is a small position. I'll give you the reason why he's saying that. Because what happens is, a lot of times, stock which look like are in a stage 2 actually come back again into the stage 1. Alright? So what happens is, that happens very frequently. That means आपके stop losses वहाँ पे hit होंगे. वहीं पे अगर आप 80% stop loss के साथ, 80% position के साथ as a trader आप चले गए, your stop loss will be tighter. So probability of getting hit, SL is more, and that will lead to frequent losses happen. So what he's saying is, buy small position, because even if this SL is hit, your loss will not be that great. But once this breakout has happened and then stock is consolidating, this is the area where you add 80% of the position at once, right? Then you sell some here, buy here, sell here, buy here, sell here. This is what he's trying to tell as a trader. Now see, I hope you are able to get the difference between an investor and trader. Basically, when he talks about an investor, you are someone who buys here, keeps adding during the continuation, and hold it as long as the stage 2 is intact. In this video, we are concerned with buy, so no selling, talk about selling. And as a trader, what you are doing is you basically buy here, sell here, buy here, sell here. You are holding in stage 2, but for a shorter period of time. So no difference there is between an investor and a trader. It's just about how much time you are actually spending. And this is what he tells here in the trader's way. So now let's discuss the important factor which I told you. That is the greater risk factor. What does he exactly mean by that? Because as we have discussed this earlier, risk factor doesn't mean how much amount of money you will lose. Well, that is dependent on you, right? Not anyone else outside the markets. What he's talking about here is the risk of being wrong even when the stock is not doing anything wrong. As I've explained, in this case here, in the drawings that I took here, see. So I'll explain what he's trying to say, right? So let's say what is happening here is, you decide to buy here at the breakout of this continuation buy. Let's draw some scenario about this and let's see what exactly does he mean by that. So your base stock gives you an up move and then it consolidates and you think it will move up. So you buy here. What then the stock does is this. But actually what is happening with the stock is, so now here you would see that the stock is breaking down. You would feel that the stock is coming in stage 4. The next moment, this is what the stock will do. What he's trying to say, the point that he's trying to get across is very simple. Let's say you bought here in the anticipation of the breakout. What happened was the stock actually broke down. Why? Because let's say agar ye move, this entire up move was, let's assume 70%. And then the stock corrected to give you 30% down move. Is it good or is it bad? It's absolutely okay. So when the stop loss is hit here, you are going wrong, but the stock is not going wrong. It is basically just coming down. And then again, the move starts. But here, at this point, there is a transition happening. At this point, you are already in an established stage 2. At this point, I'll write here, at the point 1 and 2, conjecture or 1 and 2, is what? Stage shift area. So from that area, if the stock comes down, then the stage shift has failed. So with your stop loss, your stock also went wrong. And that is the key. That is what he exactly means when he says the greater risk factor. I hope you understand. Here the stock did not go. Nothing failed, right? You are still in stage 2. Everything is absolutely fine here. But just because your stop loss was here and the stock has already gone up, it decided to come back down. And then once that is over, it will again go and give you similar kind of returns. It could be 60, 70, 50% returns. But that is what the stocks generally do. And that is what Stan is trying to get the idea across of greater risk factor. Now let's move on to a very interesting part of the slide here, which is system. And this is where the difference is, because he basically talks about how he scans for the stocks, how he takes the decisions, where to buy, where to exit, and all that. And he has given some solid piece of advice, right? So let's copy this entire data and put it on our slides whiteboard. And that is where we will understand every word that is written. So now we are here. So we can talk about the system that he talks about. And the first most important thing is, he says that, as an investor, this is your area of buy, the first area of buy, 1 point, that is at the breakout. But then you would question, how do I know when the breakout will happen? And when the breakout happens, what if I'm not at the screen? What if I'm not available on the system to punch my orders? What then? This is what he's exactly asking. For this, what he tells you to do is, there is a feature, right, called as GTD. Probably you would have heard about this in Zerodha. So what you can do is, you can go in your broker app or the website, or in there, you can have two limits that you can set. So let's say you see your stock is doing this. Yeah. And then you see that, okay, you have identified a very good stock which might go into a stage 2 from stage 1 above this red line. Let's assume the red line is what, 100 rupees. Okay. That means if 100 ke upar if the stock price moves, that should trigger a buy. What he says is, in your system, once you have identified that what is the level the stock needs to break above to establish in stage 2, you can simply put the orders on 100 rupees, the order will be triggered, and whatever quantity you desire to buy, you can have the quantity assigned over there. That way, whenever the stock breaks out, you will automatically get it. The next question is, what if the stock gaps up at 110 and moves up? Then your order will not be triggered, right? From there on, he brings us to the point of something called as slippages. And this is very important, very important. I'll explain why. Let's say this happened, your order got triggered at 100 rupees, but by the time your order reached your broker, the servers gave your order to the exchanges, the price of the stock, let's say from 100 rupees went to 108. And let's say at 108, your order got bought. What was your intended buy price? 100 rupees. But how much you had to pay? 108 rupees. That is almost 8% more than you what desired. So let's say at 100 rupees, your stop loss, you wanted to keep at 5%. But if you're buying at 108, now your stop loss is going to be much bigger than 10%. Almost doubled. So basically what happens is, it skews your risk reward and your risk management system. Then again, for this also he gives a solution. Let's say you see that, okay, the stock is breaking out, but the slippages can come. What you can do is, you can set a limit that trigger my order at 100 rupees, and the maximum price I am ready to pay for the stock to buy is, let's say, 101.6. If I get a price between this while my order is at the exchange, then only it will buy. If let's say the order is available at 102, you will not get the entry in the stock. You will get the entry between any of the price available at the moment. What happens with that is, you will be able to save yourself from the slippages that happen, these kind of slippages. And let me tell you from the experience, when you are handling big amount, first of all, this method is not the best when you want to enter, let's say, 20 lakhs or 25 or 30 lakh worth of possession. This method is not the best because the liquidity issues are there. So eventually you will have to face slippages if you follow this method, right? But this is very good if you are trying to build small position at initially, and then when you buy the pullbacks, you can have a very a good position size without any slippages. So that is also a very small difference, but a very good difference between buying a breakout and a pullback. Then let's say what he talks about the system, that is the scanning. See what he has written, that his most profitable judgments are made late at night or non-weekends. That simply means off market. During the market, he doesn't do anything. No scanning, no decisions. And that is the key. Even if I want to do intraday trades or small swing trades or anything like that, I follow the same process. I also mostly scan my stocks after the market has closed, usually in the evening or at the night. And that is what we do also for the weekly system, right? That is where the decisions are made. And that has proven pretty well, pretty excellent. Why? He gives a good reason also that not to get up caught in the fear greed syndrome. What happens is when you are at the market and you see a stock is going up 1%, 2%, 3% up, you think it might go 10%, so you buy at the plus 3%. By end of the day, what happens is it closes at minus 2%. So just a small bit of volatility and you are already at a minus 5% losses. That is what you don't want to do. He asks you to do this thing, right? Set time aside each weekend to unemotionally scan your chart publication. Basically, go through your scanners. And the scanners I've given to you. Everything has been given, right? So follow this process. And he says you need an hour for this. But obviously, the more time you can spare, the better it is. Then he says make up a list of few outstanding potential buys you see among the manning charts. That is what you have to do out of the weekly list that I publish on the channel. That is what you have to do. You have to select the best among those. Those are good. It's your job to select the excellent among those. And then you can just follow these stocks and keep adding and removing from your portfolio. So this is a great advice on system. Then comes a very important approach, is something called as a top-down approach. What exactly that is, let's see, because this will lead us to something called a sector analysis. And I have a lot of things to share about that, as those are not found in the book, but I'll give you from my personal experience. So let's first read about what he's trying to say about top-down approach. He's saying is just get the feel of the overall market. In the Indian markets, you can see the Nifty chart, the Sensex chart. If you desire, you can watch Nifty Bank Index, right? Whatever you can watch. But a Nifty is a good measure to see how the overall market is. You can also refer to the mid cap or the small cap parts also. So now let's see. After you are seeing the market, let's say your Nifty is looking good. It's in the uptrend and everything is good. It is not choppy. It is not range. Then what you have to do is you go to the smaller component. That is, after checking the index, you go and see which stock looks the best to buy. Then comes the important part. The favorable chart and bullish group. That is where the seeds of sector analysis are sown. Will often quickly advance 50 to 75%, while equally bullish chart. This is so important. So important. I'll explain. In a bearish group may struggle to a 5 to 10% gain. Now see, here he's saying bullish and bearish group. But what I'm trying to say here is, even in bullish group, let's use the word bullish group, you will have stocks which have the exact same setup. Everything is the exact. But one will move 50% in 5 days, while one will move 5% in 20 days. This also happens within a bullish group. And this is exactly the idea he's trying to give you from this written line here. That equally bullish group can have very different kind of moves in different stocks with the same setup. So the people who say that master one setup and that is it, that is what you should do, those people actually don't know these kind of things, and those people have not read the book like they should. But I'm giving it to you here for absolutely free. So make sure you make the best use of this knowledge that is being given to you. So this is the analysis that we drill down to after reading these two lines. This is very important, which are written here. I don't know how can I emphasize more, but once you understand this point, you will see your profitability and your growth of the account is going to accelerate. And that is a fact. Those who have understood it have experienced it. So this is what it means. Then, as I said, we move on to the sector analysis. Now, see, I have a few things to talk about here on sector analysis, because a lot has been said just to sound intellectual, but actually sector analysis is something, it's good, but it's not so important as people tell you to. And I'll explain you why exactly is that the reason. So see, when you go through your charts, you see several stocks from one group that are suddenly turning bullish. That's a clear-cut signal. And I believe this is all that is required for a sector analysis. This is all that is required. There is nothing else. You don't need to see the news. You don't need to see the balance sheet or the earnings or anything like that. You don't even need to see the individual index of that group. Everything is written here. That's all you need. And this is the best advice anybody has given. Stan has written it very apt. That let's say you're scanning and you see that you get 3 sugar stocks with excellent setups. Then it's your job to look for all the listed sugar companies or related companies and see that which stocks are doing this. Because even in sugar, you will have stocks which will move 50% in 5 days, while the one you took entry in will move 5% in 20 days. And that is what will frustrate you, right? So this is the point he's trying to say. Let's say you saw 2 solid IT setup. They look very good. It is your job to see the other stocks. And then among them, choose best, keeping this in mind that you don't go for this, rather go for this. It's your job. That is all that is required for sector analysis. That is what I have done. If you see, recently I think the weekly setup wala video, if you see, therein a stock I talked about, IRFC. Just see, it has given 50% returns. A lot of people took entry. I got a lot of screenshots of the profits in my email. That is all that is required. You can see the reasoning that I've given here. So that will elevate your learning. And he also gives some kind of a validation to you that it's very crucial. After years of observing and studying market cycles, there is absolutely no doubt in the mind. Sector analysis is just as important as overall market timing. This is also a good piece of advice. But what I will say is, don't just stick to sector analysis. What people then do is, they simply do sector analysis first and then they go scanning for the stocks. That's not the best part. So what I'll tell you to do is, just go through your selected stocks, however you scan them. I've given the scanners on the channel. If you use them, that's great. Among them, if you see from one sector, you get good stocks, let's say 3 or 4 stocks from one sector only. Go ahead and check the others and make your decision. It's as simple as that. So at this point, we have studied all the theory that you need. But now let's go and see some live examples. That is where the fun is, right? Just mere theory cannot help you with everything. Now let's understand the example of SDBL. And let's see what all happened in this stock. So see, if you see here, this was where your stage 1 was happening, a range. Now see an interesting thing that happened here. I'll rather use a trend line to mark everything clearly. So now see this that I draw here. This was the resistance level. So this entire area, I'll draw a box, will be your stage number 1. Okay. What did the stand book tell us? You buy some quantity here, right? But did I not tell you that what can happen then is it can come back down? That is always a risk. So let's say you bought one quantity here. The another quantity is at the pullback, and the stock did exactly that. And see from where the long tail were coming, the pin bar kind of candles, exactly at the black line that I've drawn. And see the move that came after that. That is well and good. Now see what happened after that. The stock again came back where? In the stage 1 area. And it is being volatile around the breakout area. So you have to be fine with it. And this is what is called as being patient. And then see again, stock again broke out. And then again did what? There was a resistance that was created here. Breakout. So what you can do is another entry here. And at the pullback, you add more. And once that was done, see the kind of move that the stock gave you. Okay. So now let's draw things here. Now let's take this chart, post it in the slides, and completely study it and analyze it. Now let's study it. So see here. I draw this line here, and I call this as Y. Stage 1. At this breakout, you will think now you are breaking out of the stage 1. So you have your first entry. Then we had a pullback here. Second entry. And a move came. But then what happened was, again you came back in to the stage 1 area. Not exactly into it, but you were in it back again. And see the kind of price action that was happening. Very volatile. Right? Then it gave you this kind of structure. Once you broke above this, that was your entry number 1 again. Similar to this. And then see what happened. This was the resistance. Right? Pullback happened here. Entry number 2. Now let's see as a trader where you could have bought. As a trader, this was your 1 and level 2 enter. Second continuation buy. Third continuation buy. Fourth continuation buy. Fifth, sixth, 7th, 8th. So you got 8 opportunities in one stock as a trader, and as an investor, these were your entries planned. This is how basically the smart money, the big people, plan in their entries in the stock. And as a trader, it was your job to enter here, again enter here, and exit according to whatever rules that you have. So this is where the entire stage 2 actually started. And these red lines are your continuation buy. As a trader, these are the opportunities you have to explore. So this gives us a very good idea as to, as an investor, what kind of volatility you are dealing with, and as a trader again, what kind of volatility you are dealing with. So you see, an investor had to deal with this much volatility after his initial entry here. You can refine it, we'll talk about it, right? But as a trader, what was your volatility? Very small. So this is what the book basically tells you, and this is an example I've shared to you to explain things better on, because things on the chart, as you see, look a little easier, but when you see it real time on the stocks, on the charts, it becomes a little difficult. But this should help you, because going forward in the series, you will have plenty of examples when I'll be covering everything. Because after video 6, there'll be a lot of live case studies of the charts with all the knowledge that we have learned from this particular series of all the big winners and whatever has happened in the market. That will give you a great deal of learning and a great deal of boost, that how the books are actually very different than the real time talk. And that is where you fail, because you read the books and you come to the markets. What you need is, you need the books that's required. A lot of them, in fact. You need to read a lot of good literature that has been written in the trading. Then you need a person to guide you so that you get the real time work with confidence. Otherwise, who will give you the confidence that what you're doing is right? Keep going ahead. And then definitely practice on one side is required, as we talk about. So great. And I hope this chart added a lot of value. We'll see more of the charts, but I think the video is becoming really big. So I'll cut it short here. So this video is great. There is a lot. And just imagine, we have covered only till video number 2. We have not started moving averages. We have not started the volume analysis. We have not started how to sell or how to short the stocks. Just imagine what kind of knowledge you are going to get in the coming next 4 videos. So I hope this added a great value to you, and there'll be more series like this that will be coming up. So you can let me know in the comments your feedback for the video, and I'll see you in the next lecture.